things change if the Fed raises. Do you think the Federal Reserve will raise interest rates on December 16th, John?
Oh yeah, they're going to raise interest rates. The only question now is how aggressively they signal that they're not going to raise them again for a little while. And I think they're going to have to. Janet Yellen is going to have to signal that pretty aggressively if she wants to keep some of these governors on board who are very reluctant to do it. So I think the message we get is that they're doing it now, they're getting it under their belt, and then they're going to go really slowly.
I mean, but so you're talking like a quarter point in December,
yeah.
and then it's steadily going to go up in 2016, I think is what you have called for, John. But Keith, if I were to get you in here, I just read through Goldman Sachs' call for 2016. And as far as what people are trying to price in, what are those interest rate hikes going to do for the global economy, for the U.S. economy? Goldman Sachs is optimistic on the global economy. They actually are calling for growth in Europe and Japan. Beat up emerging markets are going to bounce back.
A lot of people like Europe and Japan.
I mean,
where are they calling for weakness?
I start with
the U.S.
Yeah, I start with our model. We do our own research. We have our own model. I disagree with John because I think it's very easy to see that we're late cycle at this point. In fact, we call it super late cycle, and I think that's why you've seen a lot of returns associated with that. We're basically seeing an industrial recession, cyclical recession, deflation, a lot of things that nobody, as far as I could see, have been calling for throughout the year. So when I look at Goldman's forecast and I hear what John said, and John, I think you wrote a great article that the flexible and gradual actually confirms my point. If the Federal Reserve actually believed that this was not late cycle, they would be effectively raising rates and raising them 3 to 5 times. I mean, they wouldn't. They're scared, and they should be.
Keith, we're not remotely late cycle. We've never had a recession with Fed funds at this level. In fact, anywhere below 5%. We have the consumer very strong. Consumer balance sheets are in great shape. The financial system is in fantastic shape. Their balance sheets are better than they've been in years.
The balance sheet has nothing to do with the recession.
Well, you get a recession because you're overextended, and the Fed hikes rates enough to cause people to pull back.
No, you don't. That's inaccurate. That's inaccurate. History says that there's 3 things that are leading indicators for a recession. 1 is the corporate profit cycle slowing to negative. 2 is consumer confidence going negative from its peak. And 3 is the jobs market losing its late cycle gains. Every single economist who is late cycle always talks about consumer and the employment cycle being good at the end of the cycle. That's what we call a pro-cyclical economist. If you're a cyclical economist, you see this very clearly. Keith, this is exactly what happens at the end of a cycle.
And look at earnings on the S&P, which you started with. If you simply take out the losses on the energy side, the S&P earnings are growing this year about 7 to 8%. So the broad market actually has very healthy earnings growth. We are not in an earnings recession.
That's like a bull market marketing message. I mean, everything, the earnings situation is fine. That's not true. Financials were down 8% earnings in the most recent quarter. Industrials have negative earnings. The consumer is at peak cyclical earnings. Again, it's not just energy.
They do have good balance sheets.
Yeah, that's fine. I mean, a balance sheet doesn't predict a recession.
John, are you going to mediate?
I'm trying. I actually want to take exception with one point, that the financial system is in great shape. That's true if you look at leverage in the banking system, but we are seeing prices extended in areas like commercial real estate. You know, we had a bid fallout in junk bonds this year. There's been a lot of borrowing in the U.S. and overseas.
They're saying 40% of those junk bonds could default. 40%.
Well, so
the energy sector.
The energy, energy.
That's right. That I think is something. That I think is something that we do have to keep a careful eye on, and I know that they're a little worried about that at the Fed, particularly the commercial real estate piece. You know, that's another thing, just to talk to Keith's point. You're seeing cranes going up, you know, in so many places in this country. What I see is a commercial real estate boom building. It doesn't look to me like it's about to end. It looks to me like it's still got some wind in it.
Real quick, John, the story that you wrote today in the C section of the Journal, terrorist attacks complicating Fed efforts to resume shipments of dollars to the UAE central bank. Tell us about that.
So, Maria, maybe I should come back tomorrow and we should talk some more about that, because there's a lot going on there. But the short story is that, you know, we talk about the Fed's job managing interest rates. They also are the keeper of the currency, and 2/3 of American dollars circulate outside of the United States. They play a very quiet role in trying to monitor where those dollars are going. They shut off a lot of the dollars going to Iraq earlier this year because they were worried that it was falling into the hands of ISIS. They shut off dollars that were going to the UAE 3 years ago They've been looking to get those flows going again in cooperation with the UAE, and now this throws all that up in the air.
Wow, really interesting. John, Stephen, thank you very much. Stephen, you said you like U.S. equities right here.
Absolutely.
You like Europe and Japan as well?
We also like Europe and Japan, but we're long U.S. We think we're going to have a very big year next year.
Big debate about the economy, certainly, but that's what makes a market, gentlemen, so thank you so much.
Thank you.